It's one of the most overlooked parts of Social Security, the benefits that continue after you're gone. For spouses and children, survivor benefits can provide crucial financial stability, but only if the rules are understood and strategy is sound. Today, we're going to unpack how survivor benefits actually work and what you can do now to help your loved ones get the most out of them. Spencer, today we're going to be talking about Social Security benefits for widows and children. What do we need to know about this going in kind of at a high level overview?
Well, just like any benefit, it is based on the primary insurance amount. So that's kind of the core of the calculation that's done. What you also need to know is there's a couple of different directions this goes. One is if you've already started Social Security benefits. So if you claim Social Security benefits, then your surviving spouse, that would be a spousal survival benefit that they could claim if it's higher than the benefit based on their earnings history. The thing that you need to understand is that you're deferring that benefit as long as you can, and then claiming will increase their benefit for their lifetimes as well. So an example of this would be, for instance, if you could claim the benefit at 64, but you deferred to 70. Well, there's a whole lot of increase of that benefit, not taking a haircut on the primary insurance amount, but actually seeing some extra credits added to that they will actually get should they then take over. So particularly your surviving spouse. So again, first thing is it's based on that primary insurance amount. When you delay taking that benefit, and it can increase what they inherit as an income stream. And then finally, claiming early will reduce the survivor's legacy, both your surviving spouse and then any kind of legacy that you might have otherwise.
Great. So let's talk then about that survivor benefits for spouses. It depends on age, timing, remarriage. What are the critical things to know here?
Well, your age, again, is critical because it's going to affect the percentage. If you took at age 70 and your surviving spouse is counting on that income, it's higher than his or her benefit based on their earnings history, then they're basically going to switch over and start taking that benefit. Now, if they start to take that benefit prior to their full retirement age, then there will be a little bit of a haircut involved there. But generally speaking, for a lot of our clients, we're encouraging the higher income individual to defer to his or her age 70 if possible. And then the lower income individual will then be protected as well, because whoever survives then will have that higher benefit available to them. If we look at it, though, you can claim as early as age 60. So let's just say we have an age differential in here. We have someone who is 70 takes the benefit at age 72. Let's just say this gentleman passes away. Let's say his surviving spouse is only 59, so she's 13 years younger than him. If she then takes at age 60, then she will have a haircut of the benefit of almost 30%. So he may have had a benefit of $4,000 on a month-to-month basis. If she takes at 60, though, she's going to have something like $2,700-$2,800 as a benefit there. If she defers that benefit, then she will have a higher benefit that will be available to her. So there are lots of different ways that you can look at this. One of those is that you can switch between survivor and personal benefits. So let's just say that in this situation, this surviving spouse, she was an executive and had a really strong earnings history herself. She could take, if she had retired, she could take at age 60 and take that benefit out to age 70. So she would take the haircut on her husband's benefit, but she would still get 10 years of benefit there. Then maybe she's deferred her benefit all the way out to age 70. Now she locks in a really, really high benefit there. So she gets a significant piece of her husband's, and then she takes all of hers with the enhanced credits there at age 70.
Yeah, that's really helpful. Great. So thanks for walking us through surviving spouse. How does remarriage affect this?
Well, in that scenario, let's just say, again, we have a widow who's 59. Well, if she decides that she's going to get remarried right away prior to age 60, well, now she no longer has access to that benefit, because if you remarry prior to age 60, then your benefits then switch over to new spouse and your benefits, and you do not have any longer capacity to look back to that other spouse's benefits for survivor benefits.
Got it. Yeah, that's really helpful. Good thing to be aware of. So let's shift from spouses to children now, because I think this is one benefit that can often get overlooked. So talk us through the children's benefit from Social Security.
Well, biological, adopted, or dependent stepchildren can receive up to 75% of your primary insurance amount if they are under age 18 or if they're under age 19 and they're still in high school. So those are really significant benefits. Now, there is an overall, a global benefit there, a cap for a family that's usually 150 to 180% of a person's primary insurance amount. So say that we had, again, a gentleman pass away and he had 7 children. Well, they're all not going to get 75% of his primary insurance amount. Whereas if he had 1 child, that might be up to 75% of the insurance amount there, of the primary insurance amount, I should say. The other thing to note is that if you have a disabled child, they may qualify for life for that benefit. So if a child becomes disabled before age 22 and remains disabled, they can qualify for lifelong survivor benefits, again, based on that primary insurance amount and some calculations that Social Security does. So it's really important to note there, if there is disability prior to age 22, then there may be eligibility based on father or mother's earnings history there.
So we've kind of already talked about this a little bit, coming back to the surviving spouse, but the idea of timing the benefits can be really helpful. I think one of the crucial things here is there has to be, in some ways, other sources of income to provide flexibility. You want to talk through that and how that affects whether you decide to take benefits early or defer them.
Well, we want to look at the lifetime of benefits that may be available. And the reality is that oftentimes taking the most upfront is not going to be the best strategy. So an example of this might be if we have a situation similar to what we were just talking about, but let's just say instead of passing away at 59, now we've got spouse passing away at 65. So the younger spouse is 65, the older spouse again was 72. In this circumstance, it might be a circumstance where the surviving spouse has a really strong earnings history, and she could take based on her earnings history, and it might be higher than her spouse's earnings history. But she shouldn't do that. She should take the spousal benefit in that case, let her earnings history continue to accrue benefit, step up until age 70, then she can switch over to her benefit. So we want to look at this in concert of all of the different options. Now, sometimes what that'll mean is that she'll need to do more supplementing of that income early on with other saved assets. But the lifetime of benefits, what's likely to be 20, 30, even 40 years, for her of income stream, we don't want to put constraints on that or handicap that just because we want to have a little bit higher benefit up front. The crossover there oftentimes would be somewhere in a client's mid-70s there. So the overwhelming odds are that the surviving spouse is going to live beyond mid-70s if we look at just the general population.
Right. Okay, so the last one that we're going to talk about today is just that we come back and say Social Security benefits are taxable. And really, we need to coordinate this with a broader financial plan and an estate plan. What are some key elements to know here?
Well, one of the things, we come back to the kids. If the kids are getting benefits, they're going to go to the kid's tax return. So even if they're age 16, it's going to be their income. Now, at the end of the day, because of the way Social Security is taxed, again, with a calculation called provisional income, it's kind of wonky. In most circumstances, a child is not going to have enough income where that Social Security becomes taxable income. Surviving spouse, that's different. Let's say surviving spouse has earned income somewhere else that might be something significant, could be taking IRA distributions, could be receiving interest income or dividends or capital gains, whatever it might be. All of those other pieces will affect whether that Social Security benefit becomes taxed. Now, again, that relates to provisional income and other types of calculations there that are somewhat complex. But overall, again, it's important to remember that survivor benefits are taxable and need to be coordinated with the broader estate plan.
Yeah. Spencer, thanks for walking us through the overview of Social Security survivor benefits for widows and spouses. Clients, if you have questions about this and want to talk about your Social Security benefit and how it affects maybe your children, we would love to have that conversation with you. Until next time, take care. If you like these financial planning videos, please share it with a friend. And if you have questions, Go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.